Hello.
Hello.
Hi.
Rebecca, how you doing?
I'm doing wonderful. How are you?
I'm doing great. Thanks for joining us today.
Thank you. I appreciate it.
No problem. So what I'm going to do, just to give you a quick rundown, is I'm going to do a quick introduction about you. It's not going to be that long. You do your thing, and then we'll take some questions. That sound good?
Okay, that sounds great.
All right, then, everybody, as you can hear, so we're going to begin. As you guys can hear, I'm talking to Rebecca Stuhnagel. For those of you who don't know who Rebecca is, she has been a real estate professional for over 26 years. She's currently the founder of Solid Door Investment. I currently own over $21 million in real estate all the way from Arizona to Texas. She also has her own appraisal company, so a really smart lady. She has been doing that for over 20 years, and she's actually here to talk to us in regards to appraisal, getting your real estate appraised, talking to you in regards to what she's done, her journey, how she's come to owning $21 million. She's done also fix and flips. She's just an all-around smart lady. Whenever we need somebody to talk to, if we need somebody to talk to us in regards to advice that they have, and we always forward them to Rebecca because she's a really smart lady, knows her stuff, and we're trying to get her for something else, but we'll tell you about that later. All right. So I want to thank Rebecca for joining us, and I want to introduce the RE Mentor world to Rebecca Stuhnagel. How you doing, Rebecca?
I'm doing great. I want to say thank you so much for letting me be on today. It's definitely a privilege. Definitely a privilege.
You are welcome.
Thank you.
Our pleasure.
So I kind of started out my career, I've always been in real estate. I've been a certified residential appraisal for the last 20 years. And that's definitely helped me propel me into this space. Even though we were on the residential side, we were trained in, both areas. My background, my degree is in business administration with emphasis on real estate and land use economics. So every step of the way has, been in real estate and helped, grow and propel us, obviously to this point right now. Each step that you take, along the way kind of, helps you grow and, get a little bit better. When I was in college, I had the fortunate pleasure of working for the county assessor for a while. And while that was a great experience, it helped kind of open my eyes to, all the different types of valuation, models that are out there, whether it's assessed value, tax valuation, all the different, things that could go. And while we were there, we helped people with, tax protests, getting their valuations lowered, being able to just kind of, help people, with their taxes, answer questions, and move on. From the assessment world, it was a very different, start. Everything is kind of, more mass appraisal, and so we were doing, linear regression models, to kind of bring on, thousands of properties, all at once and value thousands of, commercial and residential properties, all at the same time. That being said, however, that sale really sparks attention at the county assessor's level. And, that was one of the, things I wanted to, talk about today, is kind of, how you can, not necessarily hide that, but, how you can get away with getting the most accurate information on your property, without sparking anything that's going to, increase your taxes on your property. But from everyone in the assessment world, it's a different, type of approach that they take. So, calling in and talking to the county assessor is so very important, just to get that accurate information. Each assessor is different, and it's kind of how aggressive is that, county assessor going to be. A lot of times, they always say drill down into, one or two markets to get to know your market and be that expert in your area. And this is very true. you can kind of look at, if you look at your taxes on your property, you can see a pattern, that kind of develops, and you can look at, the variances. When I look for our taxes, because that's the biggest question a lot of people have, how do I figure out the taxes for the, upcoming year on my property? When we look at that, we go back 10 years, and you can kind of see a pattern, developing, and each assessor is going to do it a little bit different, and it's that county level that you got to drill down to. There's no standard answer for, Texas or Phoenix, where Arizona is, that county level that you need to, be cognizant and aware of. So, call the assessor's office, make a friend, make an appraiser friend, and, kind of drill down to, I always like to use, like when we're looking at, like someone's property package, I'll take one of their comparables, and call in, because you never want to let them know what property you're looking at, because you don't want to draw anyone's attention to that particular property, but you want to, be able to, kind of find accurate information, and hopefully that comparable is, nearby, kind of the same age, same number of doors, and it'll allow you to kind of, get a little bit more information and a closer, kind of valuation of what your property, could be. But a lot of times, if you just look at the historical tax records, go back 5 years, go back 10 years, and look at it, you'll see, how much it increases, year over year. For the Phoenix market, we have it easy. Basically, whenever you purchase a property, that doesn't necessarily spark, a higher tax increase for the next year. What the city of Phoenix does in Maricopa County, they have it as where, basically the most that they can increase your property taxes is 5% year over year. So, when I'm doing my, model and, growing it out for my property, I'm going to use that maximum 5%, and then if it's 4 or 3, then I have that extra cushion in there, and it's kind of the gravy on top, so to speak. But, each person does it differently. We were looking at a property in Texas, and we stretched it out over 10 years, and you could kind of see a pattern, a 3% increase, a 3% increase, and then a 6% increase, and then back to 3%, 3%, and a 5% increase. So, that kind of means, it tells you every third year, the assessor is going to, take another harder look at your property to see kind of, if there's a chance to increase it a little further. But it kind of gives you a gauge, just by looking at what those variances are, to kind of know, where are my taxes going to land, for this property. I started out, I spent my year at the county assessor's office, and then, we moved in. I found a great mentor, in life in general. I'm a super firm believer, of having a great mentor. And so my mentor was the past president of the Appraisal Institute. I was fortunate enough to work underneath him. I was living in Nebraska at the time, so I was appraising in Nebraska and Iowa, had the dual license, and was just able to learn under a wonderful mentor, that taught us the commercial side as well as the residential side, for appraisals. And then, when we moved to Phoenix, where we're at now, I was able to, start my own business and appraisal company, and kind of go from there. I have my appraisal license. I'm also a realtor. And so we were fixing and flipping in the Phoenix market, because that was very, positive. So we were on that single family journey and didn't really realize that anything else was out there. And I ended up talking to one of my appraiser friends that actually went through, the RE Mentor program. And he, explained to me, the whole, mentorship, and he had just bought his first property. And, I was amazed and, totally, gung-ho. So my business partner, Brian, he was fixing and flipping with me, and we, just sat down and talked about, how this would be the kind of natural progression for us, to move into the multifamily space. He's a general contractor and a home inspector. And so pairing that team together, with the appraisal, side of it and the analytical side of it kind of makes a great, acquisitions team and operations team, for us. So, we, joined the RE Mentor program about a year and a half ago. It's been a fairly recent, for us to come on and, get it within the program, but we were able to kind of move fast. And we've always been that way. I've always been kind of a little bit driven, and have high expectations, of ourselves, and for our team. But we were under contract with our first property, within the first few months. We had an amazing coach, amazing mentor, and, it just propelled us to, think outside of the box. And, I was actually overanalyzing everything. Sometimes you have that fear, of pulling that trigger on that first deal. And so I was overanalyzing almost everything, and she was able to, set my head in the right frame of mind to push forward. And so we were very, thankful for that. And so, our first deal that we found was a Holy Trinity deal in 2018, and so we pushed for, and found, that property that we didn't have to do, it was the perfect first property for us, not too big, not too small. And, it allowed us to, grow and, find something in that space that just really hit our needs and, was there for solid cash flow right out the gate. We bought the property, at a 10 cap and, definitely had the cash flow from day one on that property, and it's turned into, an amazing little deal for us. And so right after, I always say it's the law of the first deal. Once you find that first property, that's the hardest part. The second and the third properties come in rapid succession. So we were under contract on our second property before our first one had even closed, and, able to, move forward and close them, a short month and a half after the first one closed. And, from then, we just kind of, exploded. We had 2 properties under contract, again, at the same time. They both actually ended up closing on the same day, not because it was meant to be that way. It just happened, one, was delayed, due to the seller, pushing the date. And, the other one was, due to actually the appraisal and another issue that came up, on the property that took a little bit more time. So, but with the 2 of them combined, it's like your education and your training never ends. Each property is a little bit different. And so, you're working with your coach, you're working with your sponsor, and it's just an amazing, opportunity to, kind of grow and move forward. Each property has its own story, and kind of a reason that you want it. And, like our Mesa property, for example, our Mesa property is a little bit more of, it was our first big property that was, a definite value add. We are going through, almost every unit in that property and doing some major rehab. It's in our own backyard, luckily. So, Brian is in, charge of all the construction, aspects of it, and we're, at the property every week and, really making a difference in that neighborhood and in the lives of all those tenants, in this property. So we're very pleased, with that deal and how it's coming along. But, each aspect and each property that we do is another kind of growth marker, that we've been able to, check off our box. And, the property that we ended up, it was a bridge loan. It had, the seller was a mom and pop, no property management in place, horrible financials, but we knew our market, it was in our backyard. We knew what it was worth, and we weren't afraid to kind of move forward. So, with that property as well, when you have that expertise or that focus, and exactly what your market, can and, will and won't deliver, that kind of, helps you be able to step outside that comfort zone and be able to take on, a project of this magnitude, without any sort of, issues or hesitation. And so it's just been a really great, kind of learning, aspect, of them, for each deal that we're on. Right now we're working on our 5th property. and, hope to close that, soon. That's our largest property to date, and it'll more than double our portfolio, as of today. So right now we currently, have the 250 doors, just over $21 million. And, that's been since the last, ultimate partnering event. So it's been very, fast and advantageous to us. And, we're just so thankful to be, in this space and in this realm and being able to, kind of help others, go on and get motivated and, come along behind us and get that first deal done. So I know that there are, yes, where are you?
Oh, nope, go ahead.
So I know that it was a live Q&A, so we kind of wanted to see if anyone had any questions or, anything that we could help them on in either appraisals or, motivation or questions about us in general.
So Rebecca, I have
Yes.
a question that was emailed in, and I wanted you to answer that question. It was just emailed in. It says, could you ask Rebecca what changed in her business to help her go from 0 to 21 million?
A lot of that was mindset, like Jeannie will attest to, kind of sometimes it's just you're standing in your own way, and you kind of think that, oh, I can't do this, or, maybe we should just start small, and it's those limiting beliefs, in there that, can sometimes just, backfire and hold you back. And so we never really, wanted to have those limiting beliefs. I'll have my, it's like a 5-second rule, whenever I have that doubt, it's like you just kind of, I'll have that doubt. I'll let it, ponder for about 5 minutes, and then I shake it off and just run with it, because a lot of it is mindset, especially with, like we closed 2 properties on, the very same day. And everyone, kind of looked at us as like, wow, that's really a lot. And, we were able, to get it done, because we had a great, mentor program and everything behind us. It's like we had our coaches, we had our sponsors, making sure, and looking over your shoulder every step of the way, just making sure that, all the, I's are dotted, the T's are crossed. And so, most of that, in my mind is just that mindset. I wouldn't have gotten there if we renewed our coaching, for the second year, because we made it to a certain level. We got a couple properties closed, but now I want to continue to buy properties, and move on even further. So, it's that extra layer that how do I get to where I want to be now, and I've always had a coach and a mentor, most of my, adult life. And that really, to me, is, one of the most important, things, especially, because our first, several properties, were not too big, but, not too small. We started out with, 68, we would do 48, our Mesa property was 84, and we're ready to jump into that, 360 plus, and it's the relationships that you make, throughout the process, everything that you need kind of is within the RE Metro program. And so, it's that, who you meet that can, propel you to that next level and bring you up. It's always one hand up and one hand down to bring up the next generation of people, behind you. So if I extend my hand upward and someone helps me, get to that next level, I'm also going to, throw my hand down, and bring someone up to, the level that we're at now. And that's, I guess, one of the most important things that, I truly, truly believe in.
Okay. We do have some more questions that were emailed in, but we're going to let Rashawn see if there's any questions on the line. Rashawn, are there any questions?
Yes, our first question comes from James. James, please state your question.
Hello, Rebecca. James Herbert, Tulsa, Oklahoma. When I look at property taxes, I only see a 3-year history. Where would you find a 10-year history?
So each county is going to be a little bit different. And some counties will have everything online. Most of the time I can get back to a 10-year history on a property. If there's only 3 years online, you have to be very careful because you don't want to draw attention to your property per se. And so it would be, again, a county by county basis where if you're able to, find that history, and go back through the tax statements. Another place that you could do would be the property management, depending on how long they've owned it, and ask for those in your due diligence, and or the seller, because they should have, copies of all of their, what they paid for the property. And just being able to go back, more than 3 years is kind of key, because you wouldn't see before in the example of 3%, and then 6%, you wouldn't see that trailing block in history unless you kind of went back 10. So however you can do it without drawing attention to your property is probably the best kind of way, because when you're talking to the assessor's office, you don't necessarily want to let them know which property you're looking at. So I would go through the property manager or the seller to see how far back in history you could get information.
Very good. Thank you. Yeah, property taxes have been one of my Achilles heels here in Oklahoma.
Yes.
Just the taxes are very high. But I like the idea of going back and look at the history. Thank you very much. Appreciate it.
Yeah, taxes are one of those key things, where it could vary so heavily, during that first year, after you purchase that property. Also, don't be afraid to hire an appraiser to do that tax protest for you. There are certain companies, and your property manager will probably be able to point you in the right direction of an appraiser or a company that specializes in tax protests, to kind of keep that low. You'll pay a little bit for the appeal, but it's definitely worth it if you can get any sort of savings out of the property, because they'll nitpick your property to death. And, that's exactly what you need in order to get that cost savings on there, because taxes are one of the, biggest expenses that could vary and throw off your numbers. So you want to make sure that it's a good conservative, factor.
Tulsa County's got a estimator on there. As long as I pick the right taxing district, put in the purchase price, it calculates it for me. And every time I call them, they refer me to the estimator. They said, we're not going to get any better than that. There's not a formula that's going to get you better than that. And in my underwriting, I have seen different owners that have utilized companies to protest the taxes. So I see that probably on 25% of the properties I underwrite.
Right. Yeah, and, that's the difference. The other 75% aren't really going after, that tax savings, but that could be, huge for your property and for your investors. So, my philosophy is, always go after it, because it's worth it, even if you have, even if your cost savings, is definitely going to be less than what you paid, an appraiser or someone to kind of help you through that process of tax protesting. But I would definitely get with a property manager that's used to and has done a tax protest in the past, just because they'll be more familiar with the process and how often it works and what those percentages kind of that they've seen in the past are.
Perfect. Thank you. Appreciate your time very much.
Yes.
Thanks, James.
Thank you, Jermaine. Appreciate you, sir.
No problem. Rashawn, are there any other questions on the line?
There are no further questions at this time.
All right, guys, you guys got to get on the line and ask Rebecca questions. How often do we have somebody who has one time been in your shoes and now they have done tremendous things with their business? So you guys want to get on the line and ask her as many questions as you can. And I know a lot of you guys have some questions that you want to ask somebody who started from, where she was until where she is now, and it happened pretty quickly for her. So I do have a question for you that was emailed in. And so this one says, Rebecca, how did you pick your first market? What characteristics did you look for in that market?
So our first market was Texas. I know Maricopa, and Phoenix like the back of my hand. But because, I knew it so well, the cap rates here are very, very low. Most of the time they're less than, 5%. So we kind of knew that we had to, you know, keep one eye on Phoenix and one eye on another market. And it was definitely Texas for us, you know, especially, you know, with the fact that they're a non-disclosure state. You know, I can kind of, you know, hide some things from the, you know, county assessor on my taxes. You know, I love that, you know, because we are definitely in a disclosure state where they know exactly what I paid for the property. So Texas, the economy, the job growth, everything we just loved about it. And so I actually trained a broker on exactly what I was looking for in the market. And he was with a smaller kind of boutique brokerage. And we sat down and went over, you know, the whole underwriting template, you know, and I told him, you know, if these are the criteria that we're looking for, and it helped save us a lot of time, you know, not being able to have to like wade through the, you know, mass amount of properties. I still probably looked at over 100 units, you know, or 100 properties before we kind of found that first, you know, deal that worked. You know, but it was him that, you know, called me and he's like, hey, did you see this property? And it was in Big Spring, Texas. He's like, did you see the property in Big Spring, Texas? And I said, yeah, I saw that, but where is that? You know, and so he's like, you know, do it now. The numbers, he goes, I think it works, you know, and so, you know, we sat down and underwrote it and he was right. You know, the numbers definitely, you know, did work. And so, you know, we were able to call, you know, immediately and, you know, put an offer in, you know, on that property. So it was just that quick, fast action. We actually met a couple other people that also put in bids on the same property, you know, that we did. And, you know, because we were fast, you know, and took action, you know, on the property and put in that LOI, that, you know, we were the ones that, you know, got it under contract first. So it was, you know, and then once we found that property, then we just kind of drilled down into that market specifically, you know, and said, hey, it's only 68 units. Let's find something nearby to pair it with and do economies of scale. And so they were able, you know, to find 49 units about 1.5 miles away from the property, you know, within the first couple months. And so, you know, just having your broker be able to, like, don't be scared to take on a smaller property. If you know you have a broker out there that's eager and hungry to go find you another one, you know, that's nearby, you know, talk to all the neighboring, you know, properties and get to know them. You know, maybe someone is interested in selling, do that kind of extra step, you know, that it's the things that most people are not willing to do that get you, you know, that step up on the competition, kind of, so to speak. You know, so we were able to, you know, find that other, you know, property before it was even, you know, listed on the market. So, yeah, we just loved, you know, Texas and, you know, all that I had to offer as far as job growth, you know, and right now, you know, we're well ahead of our expectations, you know, on that property as far as, you know, in terms of cash flow. And so it's been a great kind of learning experience, you know, for us. I was very conservative in my underwriting, you know, that's the appraiser in me. And, you know, even though it was fully occupied, you know, we still ran with a 10%, you know, vacancy rate that first year, you know, just for the what if. You know, I know Jeannie would say I probably what ifed it to death, but, you know, that's kind of what you do on your first property, you know, but having that mentor behind me, you know, was what allowed us to kind of, you know, go for it, you know, and so we were just kind of, you know, truly blessed to, you know, be out there and in the market and, you know, be able to move forward. So, yeah, Texas definitely has some great opportunities. You know, because the job growth and the economy is, you know, still there. They don't quite suffer the recession, you know, like for instance, the Phoenix market or Las Vegas does. And, you know, so kind of as you prepare for, you know, the next economic downturn, you kind of need to look at those markets that have historically rebounded very fast. And Texas was one of them for us. So that, you know, still remains our primary market to this day.
So you said you trained your broker. How receptive was he for the training?
You know, he was with the Keller Williams commercial brokerage. So he was with a smaller boutique brokerage. You know, I didn't go after the Marcus & Millichap or the CBRE, you know, because those are the, you know, long time old, you know, it's kind of, there's a lot of old appraisers out there too, you know, and you're never going to, you know, teach an old dog new tricks, you know, but if you find someone that's younger, you know, and hungry, they're more receptive to, you know, okay, let's talk. And, you know, I shared with them, you know, our underwriting, you know, template, and I helped him kind of look for exactly what we were looking for, you know, so we underwrote a property together, you know, and I told him, you know, and it was a property that I already underwritten and, you know, knew didn't work, you know, but all the brokers were, you know, saying, oh, this is a great property, you know, you should take this one. And, you know, of course, you know, they're going to say that. And so we, you know, underwrote it together, you know, and I told them exactly, this is why this one doesn't work for me. And, you know, we're syndicators. We were very upfront with them about, you know, being, you know, syndicators. We were very upfront with them about being new to this business too. And he appreciated it a lot more than I kind of was receptive to. You know, I was a little scared in the beginning, you know, to let them know that we were new at this and we were going after our first property. They actually started having like weekly meetings about us because they knew, because we were a part of a larger group and we had a bigger appetite, that we weren't like a mom and pop or a one and done, so to speak. And, you know, what I mean by that is, you know, a lot of, you know, mom and pops, you know, in this industry, they'll buy one property a year, you know, and that's it. And then they get comfortable, you know, and they'll move on. Or, you know, maybe they'll only buy one property, you know, and just manage that property, you know, and get comfortable. And, you know, because they knew we were syndicators and we were part of, you know, a larger group, you know, out of Boston, that they were very comfortable with us being able to perform. You know, we did exactly, you know, what they said. We leveraged, you know, off of our sponsors, you know, reputation and background. We've had an amazing sponsor, you know, on this deal. And, you know, he was our sponsor for, you know, all 4 of our properties. And, you know, being able to leverage that track record, you know, kind of helped, you know, propel us forward. And he was, you know, not scared to, you know, work with us. In fact, he was excited to work with us. And I don't think that we would have gotten that from, you know, a Marcus & Millichap or a CBRE. I think that, you know, we would have been there. They're more so looking, you know, for the bigger players, you know, and the big dogs that they know that can perform, you know. So, you know, look for someone that's, you know, young, hungry, trainable, you know, because they will go after and they will do a lot of things, you know, that, you know, other brokers won't, you know, because they want that business and they, you know, they definitely want to go after it. So it was great. It really worked for us.
All right. Rashawn, are there any questions?
Our next question comes from Richard. Richard, please state your question.
Yeah, hi, it's Richard out of Chicago. I'm new to the mentorship program. Thanks for chiming in today, Rebecca, to help us weed through some of the challenges that we have throughout this whole process. But a couple of questions I have, you kind of touched on one of them in your prior explanation. But in terms of finding your deals, have all your deals come through brokerages, or did you try the direct mail approach? What's been your sweet spot with respect to finding deals? And then the second part is, in terms of funding, were you able to raise most of the funds yourself, you know, through your own individual networks, or did you leverage your sponsor in that regard?
That's a great question. In terms of deals, we basically look at it from all aspects, you know, leverage your strengths. So, you know, our broker pretty much found us, you know, all of our deals, but they all came from, you know, different sources. So like on the last deal that we're currently doing, our Atlanta project, that was a wholesale connection that I had from fixing and flipping. And so, you know, you always kind of are out there in the industry or out there in the world telling everybody that you know what you're doing now, you know, and getting that word out. And so we had told all of our wholesalers, you know, that we're sending us residential properties that, hey, we're looking for multifamily. And, you know, it's kind of like flipping on steroids a little bit, you know, going from the single family world to the multifamily world. And, you know, so they were all for it. They were like, oh, wow, okay, so I can find you, 60, 80 or more, and you'll take it. And, we told them, yeah. So it was a wholesale connection that we had, that brought it to us. And we worked with our broker that we'd worked with the other ones on, because sometimes in the wholesale world, you kind of have to work through the muck of who actually has this contract, because it was an assignment contract. And we finally got it down to the actual broker who, had it, was able to establish that connection, but it took probably almost 2 months, to pin that down. And it was our broker's like tenacity and follow-up and, my follow-up and, just going after that deal, time and time again, in case something, happened. A lot of times too, if I ever lose out on a deal, I'm always in backup position. I'll always call the broker back, and let them know that, hey, obviously I didn't win out, on price or terms or whatever it is. And, but I would love to be in backup, position on this property. Our Mesa deal, it was actually one of the first properties that we found, but the, fourth one that we closed. And what happened was they, had it through, it was a pocket listing. So it was exposed to only a couple, people, like a handful of people. I think probably, 5 or 8 people in the industry. There was a larger person out of Canada that owns thousands of doors here in Phoenix. And he was our main competitor for the property. And what we ended up doing was nobody was listening to the seller. So I built a personal relationship with the seller outside of the brokerage. And that's basically what won us that deal. He was going through a divorce. And so, we knew it was going to take time, and he needed to feel comfortable with us, comfortable where he was at, in the whole, type of, divorce situation. And he was also a busy professional, so time and time again, extension after extension, we were like, hey, take your time, we're here for you whenever you're ready. And, while it was under, it was just under LOI, he didn't want to sign certain things, which was tricky, but, we got it done and was able to, hang in there, but it was just appreciating in value the longer, it didn't close. So we were okay with that. When we walked into that property day one with instant equity for our investors. And so that was just a great, great feeling, whereas most of Phoenix, trades at a 5 cap. We bought that at a 7.4 cap. So, we negotiated terms and everything up front, but, it was that personal connection and that relationship that I did with the seller outside of the brokerage that won us that deal. So, it's kind of a combination of everything. I wouldn't be scared to work with, a buyer's broker, in the beginning. You always want to go direct to seller if you can, because that'll give you that leg up. But if that isn't working for you, try a buyer's broker, that's young and hungry and is going to kind of go after deals for you. If they're the right type of fit, they'll kind of get it done. And then the second part of that question on raising the money, that's kind of always been our challenge, and as we grow and get bigger, so does our investor, database, and pool of people, that we know and connect with. There's, you're going to, several events throughout the year, you're meeting new connections, you're developing like stronger relationships and stronger bonds with people, and you're constantly, networking, to kind of grow your database, grow your sphere of influence. So on our first deal, it was like a combination of a lot of things. It was us and our coach, that helped us raise about a third, and our sponsor helped raise about a third. And then we also were able to connect with and partner with someone that had gone through the program before us, ahead of us. So they had more experience and more investors, in their database. And we partnered with them, brought them on to the GP team with us, and they were able to raise about a third as well. So, the part that I love about it so much is how everything is connected, especially with your sponsor, because your sponsor is a performer. They're out there to close deals. And so they're going to, move heaven and earth, to kind of get that deal closed because, they also don't want to look bad. They have that track record of performance. And, so everyone just kind of pitches in together and, gets it done and helps you, move forward. We've raised, over $6 million, probably close to $8 million, I guess now, of capital, for our deals, to get them closed. And it's definitely been, a journey. We're still perfecting, that journey, as we go on. But it's finding those deals that have that story and that amazing track record and being able to kind of tell that story, to your investors in a way that, helps them, feel comfortable with the property, feel comfortable with you, and move forward. But always, let everyone know what you're doing and that you've moved into this space and, leverage off of your team. We have an amazing team and, we're very fortunate, to, have that, uniqueness to us a little bit that helps us stand out, in the world. So, but, most of it, as far as the investor side and deal side, comes from, being able to tell that story of that property.
But Richard, one of the things, the key word that she used is that, and I want everyone to listen, is that she said all her deals have worked. They've met the criteria. So she didn't just put a deal in front of their investors and say, hey, invest in this deal. She showed them how the deal was going to work and how the cash flow was going to work for them. So that's the reason why they were able to give them, to be able to find money for their deals.
Mm-hmm.
Got it.
And I think sometimes people just think if they have a deal that someone's going to invest in it, and that necessarily doesn't happen. The deal has to work for everybody involved in order for them to actually want to participate in that deal.
I can interject as well. I think it's really important to know that you must fall in love with the numbers before you fall in love with the property, because once those numbers hit that bingo, there's no way you're letting that go. So you got the bingo numbers. Now you got to portray that excitement to your investors and let them know the plan for the property moving forward and how, it's a different world from being an appraiser, isn't it, Rebecca?
Yeah. Yes, it is.
Yeah.
I remember.
We had a decision to make at one point, didn't we?
Mm-hmm. Yes. A very tough one.
Yeah. Rebecca just had that anal appraisal world, and I gave her a choice. You either want to be an appraiser or you want to be a real estate investor. You decide. And she decided the real estate investor, and look at her now. She's a rock star.
Oh.
Thank you for that.
Any other questions, Richard?
Just don't want to tie the line up too much, but I guess Rebecca did mention that one of her deals was a 7.4 cap. I guess, how did you end up structuring that deal to your sponsor? Did you end up lowering your portion of the returns to get up to the 8% for your investors?
Great question.
Yeah, that is a great question. No, every property is a story, right? And so even though it was a 7.4 cap, they had a lot of things that were wrong with the property. So they were doing, it was a mom and pop. They didn't have property management in there. They had very high collections and, accounts, they weren't collecting their rents on the property. And they weren't really doing anything about it. They were hardly doing anything at all, on the property. It was really bad management, and that's an opportunity, right there. And
also the value adds. If everybody in the neighborhood is billing back for utilities and you're not, you're missing out. if they're not billing for pet deposits and extra storage and things like that, those are all value adds that increase the bottom line of the property.
Yep. Yeah, and so we were able to go in. There's 2 huge walk-in closets. We're able to take one of those walk-in closets and turn it into a laundry unit inside the property. So each unit is going to have their own laundry, in there, which is going to add about $75, dollars a month, to the monthly income on the property. Then we're able, once that's completed, we're able to, take the laundry room, turn it into a nice, clubhouse or fitness center. But yeah, they weren't charging, for things like that. And so there was an opportunity there. They were about $120 under market rents because they weren't remodeled. They had the old laminate clank floors, and carpeting, and older white appliances. We're going in there with a full, because it's Phoenix, unfortunately, we're going in there with, granite countertops, black appliances, vinyl plank flooring, all those upgrades that everybody wants in our market, because we know our market so well. And, with our fixing and flipping, we're able to get the granite, even though it's granite, or quartz, we're putting in quartz at a great price point. So that's going to increase our bottom line. So just because we bought it at a 7.4 cap, we're able to increase that value over the first year. So for us, the cash flow is minimal on the first year. Almost everything is going to our investors, but it wasn't our first property. Our first couple properties were cash flow properties. This is more of an appreciation property. So we give most of our cash flow to our investors that first year, and that's going to pay off in dividends by the end of the year. As an appraiser, we look at different types of way to look at that property. And so we're just not focused on that cap rate per se. We're also looking at, what is the price per door trading? What is the, market trading? And how does our property, stack up and compare to everyone else? Where are the variances in the marketplace? So, we, purchased that property, for about $88,000 a door, price per door. And we are looking to sell that at, roughly around $155, $160 a door once we get the value adds in place. So this is a, definite, type of property that we will probably not hold on to very long because we're going to take advantage of the Phoenix market, in that space, and that's exactly what we, kind of sold to our investors. This is definitely a kind of flipping on steroids, property. And, but it wasn't our first deal. And so, we're ready to, kind of take on that repositioning that's going to, pay off and set us up with a really nice track record going forward.
Does that make sense, Richard?
Oh yeah, absolutely. Yeah, if the deal works, and it's a little bit lower than the 8 cap, if the numbers, if the exit strategy is there, then what she's saying is, you sell that to the investors, and you get it done.
Yep.
The other thing, Richard, you have to think about too is maybe it doesn't cash flow the way you want it to right out of the gate. Maybe it comes in at 11.2 and you really want that 12%. But look at the 3 months into the first year. That's when you really talk to your investors, because typically you don't pay any investor checks until after the 3-month mark. And if you can implement a bill back system on the water, that alone gets paid at the same time as your rent gets paid. That automatically increases your income so that when you're ready to make those cash flow checks, the numbers have increased substantially.
Got it. So, sorry for tying up the line again, but so are all sponsors open to that concept of going in at a little bit lower than, say, an 8 cap? Are most of them willing to do that, or is just like a tiny percentage of sponsors willing to do that?
Well,
I think that'd probably be a great question for you. Yeah.
I'll take that one because I deal with most of the sponsors, And most of them, this is not their first rodeo. They aren't really in it to increase their income coming in on a quarterly or a yearly basis. They're more interested in getting to the next level to sponsor the larger deals. So anytime they sponsor a deal, that increases their net worth, which gives them more clout in doing the larger deals and the institutional deals. So it really isn't about the, couple of $1,000s they're going to make on a quarterly basis. It's more about them getting to their next benchmark. Maybe now they're at 10 million. Maybe, after this property, they'll be at 12 or 13 million. So they're just inching along to the big money deals.
Gotcha. Makes sense.
All right, Richard.
Thanks again. I appreciate it. Those are
No problem, sir.
It's our pleasure to talk to you.
Yeah,
Thank you. Sean, are there any other questions?
Our next question comes from Joe. Joe, please state your question.
Hi, Rebecca, Jeannie, and Jermaine. Joe Zanelli from New Jersey.
Hey, my buddy.
How's everybody?
Good, Joe.
Good. Guys, this is really to help some incoming students because I just did a week in Oklahoma, and I put on my Facebook, I think they're probably the nicest people I've ever met because a lady hit me with a shopping cart in Walmart, and she apologized, so I wasn't expecting that. But they're really cool. So as far as helping the group, I need to say this. I had sit-downs with close to 8 or 10 brokers, and I was really proud. I dialogued with these guys between 1 and 2.5 hours, and they didn't want to go. These guys were talking to me, and they were listening. I was truly listening more than I was speaking. But things that I think will help students that are coming up is knowing the language of this business, speaking that language, knowing the difference in the wording, what's pro forma, what's a value add. Believe it or not, I spent a lot of time on learning the jargon, and I think that's what kept me in the game. A couple other quick bullet points. The limiting beliefs that Rebecca said, oh my goodness, so important. I actually had to convince myself that I could do $1 million deals. In my other life, I've done many deals, a couple $100,000 in residential, and I did really great. But I'm in a whole new platform here, so I want everyone to know it's a mindset that you have to break through on, being able to do $1 million deal. And then just one or two quick points. I don't want to tie up the line. Rebecca made such a key point about finding someone who's hungry to work with you. And I do that too. I look for a broker that I can have a meeting of the minds with. And I'm also like a highly motivated guy, so I never let them down. I let them know that I'm in it to win it. And if they work with me, we're all going to win at some point. And let's see. Okay. I guess that would really be it. I think Oklahoma's where I'm going, and I just thank everybody for, letting me put these questions in.
Thank you, Joe. We appreciate
Joe, give me a call, and I'll give you a couple of people over there.
Thank you, Jeannie. I sure will. Appreciate your help.
You're welcome, Joe.
Okay. Bye now.
All right, guys. I know we usually go till 2, but we were a couple of minutes late, so we're going to stay till about 2:05. Okay. So, Sean, are there any other questions?
Yes, our next question comes from Eve. Eve, please state your question.
Hi there. Hello, everyone. This is Eve from Chicago. My question has to do, I missed the beginning of the call. My question has to do with appraisals. Rebecca, can you please put on your appraisal hat for a second?
Yes.
I'm struggling with when there are no comps, there are no recent comps or no nearby comps. From an appraisal standpoint, how do you what do you do when there's no recent appraisal and there's like maybe it's a year or 2 years or it's not nearby? What formula do you use for that?
So on the commercial side of it, when you're appraising multifamily properties, your primary valuation is that cash flow. So it's going to be, your net operating income, is going to set that. That's not to say that, the lender's not going to want to see some comparable properties in there, but there's nothing that holds an appraiser back on the commercial side from that time restriction, or that area restriction like it is on the residential world. On the residential world, it's all, comparable properties,
right.
And like kinds, apples to apples type of thing. So you can go back historically, and take that year-old comparable sale, depending on your market. You can also take that comparable sale that's maybe 5 or 10 miles from your property. Hopefully you're looking at a MSA that's, over, 100,000, in population, so that you do have a lot of, comparable properties, to pull from. A lot of times too, you're not going to see the properties that are out there, but your appraiser is going to know those sales. They know all the brokers, they know all the, we were trained, the old fashioned way, of actually going down to, the courthouse and pulling, records, just in case that, ever happened or needed to, come about. And, that's a lot of what the commercial world is, even though everything's, online and recorded, it's those connections and those relationships that they maintain with those brokers in those areas, that give them the information, that they need. So just because a broker can't find comparable properties for you doesn't mean the appraiser is going to have, an issue, pulling that up. But primarily they're going to rely on that income stream, that net NOI, to determine the value of your property, times the cap rate that's in your area. So, and they do that, by determining, what has, gone on in the past. You still want to compare apples to apples, so you're not comparing, a 20 unit to a 100 unit, because that's just in the different, realm and space of things. What I also see a lot of brokers doing that I didn't mention before, when they're doing their pro formas and putting their packages together, you want to pay close attention to the square foot calculations, because everyone will put in there, here's the, square foot for, a 1-bedroom property, and it may be $112, or $1.12 per square foot, whereas that might be misleading if it's a smaller, property or a smaller, 1-bedroom. So you really want to make sure that you're comparing apples to apples, because the smaller the size of the property is, it's like an inverse relationship between size and price per square foot. So, you want to make sure that if I'm doing a 1-bedroom that's, 900 square feet, the variance that I have is only about 20%. Otherwise that's not really it's probably not $1.12, per square foot. It's probably more like 98 cents per square foot. And that can really throw off your numbers. But the brokers love doing that because it gives them a higher, look what you could, possibly get on your pro forma. So, just make sure that you're comparing apples to apples, but I wouldn't worry too much about the appraiser, being able, to make your numbers. Just make sure you're staying in that higher population density area, so that there are other properties out there to compare it to, because they'll take, a larger property, and drill it down, to compare, as well. Or a smaller property, if they have to. But does that help answer your question?
Yes. Is it the 20 unit, is it less? A 20 unit would be less per square foot or more per square foot than a 100 unit?
So not necessarily more per square foot. So like I was talking about like the size of like your units, like when you're determining what your rental is per, unit for like, let's say a 1-bedroom, property. There's an inverse relationship between size and price per square foot. So the smaller the property, the higher the price per square foot.
Okay, that's what I was asking. Okay.
Yeah. And so, but, also on the, some of the smaller properties, like especially if you're looking at that fourplex or that, eightplex or whatever, and those type of deals, they are more on that residential area and more of a market approach versus an NOI approach. So you do want to make sure that, if you're looking at an 80 or 100 unit property, that your comparables are, also, 60 or 80 unit properties.
Okay.
And not like a smaller one, because that will be, a higher price per door or a higher, overall valuation than a larger property would. It's kind of like the bigger you go, the cheaper it gets, because it's economies of scale. Mm-hmm.
Okay. Thank you so much.
Yep.
So, Rebecca, I got an email from Maurice Filligen, and he wants me to tell you that you are one of his most favorite people in RE Mentor, a real person who I love to work with. Please tell her. She is so right about connecting, and just being around her in some way has given me more insight and confidence. She is a whip, and I love listening to the calls when I can. And he goes on, but he just loves you. And so don't I. And I want you to know you did fabulous today.
You have a lot of fans, Rebecca. You have a ton of fans. We do want to take one more call, though, if that's okay. Rashawn, this will be the last one. Rashawn, can you punch up the last call for us?
Okay, our last question for today comes from Renee. Renee, please state your question.
Yes, hi. Thanks for taking my call. This is Renee. Rebecca, I met you at the UP this year. It's my first, and you did a great job with your presentation at the Shark Tank. So, way to go.
Thanks.
And my question is, you mentioned that you had a coach and a mentor.
Yes.
So, what's the difference? And I have a coach. So, what's the mentor piece for you? Thank you.
So most of the time, it's kind of one and the same, whereas you'll either have, a mentor that, kind of, brings you up to that next level, or you'll have a coach, that, can answer your question and, bring you up to that next level. So, my mentor, when I was going through my appraisal, part was, the person, that kind of, trained me and brought me up. He was past president of the Appraisal Institute, very well known in the industry, and, we would meet, once a month just to, kind of more inspire me and, help me, introduce me to people, bring me up to that next level. What are you doing now? What are you doing that's different? How are you marketing yourself, and kind of that guidance, whereas like your coach, it's typically someone, that you either meet with weekly or every other week, like through the, RE Mentor. Everyone here, has a coach, that kind of, answers questions for them, provides them with inspiration, provides them with guidance, and helps put them on the fast track. That's where you want to be. You want to be on the fast track to, to success and, to getting, to that next level. So there are many different, most of the most successful people in the world, have either coaches or mentors, or sometimes even both, and sometimes, you might not even have to pay for, a mentor. If you can work out, if you meet someone that's, very successful, in your industry, and you can add value to them, a lot of times, when I was first starting out, I did an internship, that was a free internship. And so, I kind of had to suck it up a little bit, but it was definitely worth it, because then I was able to, get on with the county assessor as a full-time paid, personnel and move myself forward. So if you can add value to someone, help them do comps, help them with marketing, help them with, a piece that they need, you may be able to, to trade that experience and that wisdom for free, just by leveraging yourself and listening to what their needs are. It's always a give and a take, and if you can come to the table offering, to give them something that they may perchance need, whether it's your skills as a marketer, your skills as, an underwriter, whatever it may be, there are ways out there that you can, help propel yourself and, throw yourself out there even faster, just by being able and open to thinking outside the box and kind of, moving forward to propel you where you want to be.
Yeah, look at how successful Dave Lindahl is. He must have at least 7 coaches that I know of. He has a business coach. He has a coach that trains him for his triathlons and his bike riding and his exercising. He has another coach that controls his eating pattern, and then he has coaches everywhere. So, I mean, to this very day, I'm meeting with my mentor, I'm meeting with my coach. So no matter how successful you are, you always need somebody to bounce ideas off of.
All right.
I totally agree.
Thank you, everybody. We really appreciate it. Rebecca, you're a rock star.
And thank you. I
Excellent.
appreciate you saying that.
You did
Oh my
excellent,
God, this was,
Rebecca.
Let me tell you something. I'm gonna give you some insight of how great this was. Usually when we do these things, I get kind of nervous because you're not sure how people are going to react, knowing how they're going to be talking to other people. We have, anywhere between.
I was sure.
I know Jeannie was sure, but I'm going to tell you, I was sure too. I said, Jeannie, didn't I tell you she was going to be fantastic? And you didn't disappoint. You were absolutely 100% what I expected in this call. And I really, really, really do appreciate it. And I hope that you do take the time to do this with us again later on in the future, okay?
Yeah, I would love to, be able to do that, and if anyone ever has, an appraisal question, reach out to Jeannie. She'll give you my number. I'm a phone call away.
All right,
Thanks
then, guys.
again, Rebecca.
Hey.
Have a great rest of the day.
Yes, Rebecca, thank you very much. And for everyone else out there, have a wonderful week and happy